strategist, an institutional advertising campaign, or something else that does Berkshire no good simply because the money currently is rolling in? That makes no sense to us. We neither understand the adding of unneeded people or activities because profits are booming, nor the cutting of essential people or activities because profitability is shrinking. That kind of yo-yo approach is neither business-like nor humane. Our goal is to do what makes sense for Berkshire's customers and employees at all times, and never to add the unneeded. But what about the corporate jet? You rudely ask. Well, occasionally a man must rise above principle. Although the news revenues have grown only moderately since 1984, superb management by Stan Lipsey, its publisher, has produced excellent profit growth. For several years, I have incorrectly predicted that profit margins at the news would fall. This year I will not let VU down. Margins will, without question, shrink in 1988 and profit may fall as well. Skyrocketing newsprint costs will be the major cause. O. Feckheimer Bros. Company is another of our family businesses, and, like the Blumkins, what a family. 3 generations of Heldmans have for decades consistently built the sales and profits of this manufacturer and distributor of uniforms. In the year that Berkshire acquired its controlling interest in Feckheimer, 1986 profits were a record. The Heldmans didn't slow down after that. Last year earnings increased substantially and the outlook is good for 1988. There's nothing magic about the uniform business. The only magic is in the Heldmans. Bob, George, Gary, Roger and Fred know the business inside and out, and they have fun running it. We are fortunate to be in partnership with them. Chuck Huggins continues to set new records at Seas, just as he has ever since we put him in charge on the day of our purchase some 16 years ago. In 1987, volume hit a new high at slightly under £25 million. For the second year in a row, moreover, same-store sales, measured in pounds, were virtually unchanged. In case you were wondering, that represents improvement. In each of the previous 6 years, same-store sales had fallen. Although we had a particularly strong 1986 Christmas season, we racked up better store-for-store comparisons in the 1987 Christmas season than at any other time of the year. Thus, the seasonal factor at Seas becomes even more extreme. In 1987, about 85% of our profit was earned during December. Candy stores are fun to visit, but most have not been fun for their owners. From what we can learn, practically no one besides Seas has made significant profits in recent years from the operation of candy shops. Clearly, Chuck's record at Seas is not due to a rising industry tide. Rather, it is a one-of-a-kind performance. His achievement requires an excellent product, which we have, but it also requires genuine affection for the customer. Chuck is 100% customer-oriented, and his attitude sets the tone for the rest of the Seas organization. Here's an example of Chuck in action. At Seas we regularly add new pieces of candy to our mix and also cull a few to keep our product line at about 100 varieties. Last spring we selected 14 items for elimination. 2, it turned out, were badly missed by our customers, who wasted no time in letting us know what they thought of our judgment. A pox on all in Seas who participated in the abominable decision. May your new truffles melt in transit. May they sour in people's mouths. May your costs go up and your profits go down. We are investigating the possibility of obtaining a mandatory injunction requiring you to supply. You get the picture. In all, we received many hundreds of letters. Chuck not only reintroduced the pieces, he turned this miscue into an opportunity. Each person who had written got a complete and honest explanation in return. Said Chuck's letter. Fortunately, when I make poor decisions, good things often happen as a result. And with the letter went a special gift certificate. Seas increased prices only slightly in the last 2 years. In 1988 we have raised prices somewhat more, though still moderately. To date, sales have been weak and it may be difficult for Seas to improve its earnings this year. World Book, Kirby, and the Scott Fetzer Manufacturing Group are all under the management of Ralph Shea. And what a lucky thing for us that they are. I told you last year that Scott Fetzer performance in 1986 had far exceeded the expectations that Charlie and I had at the time of our purchase. Results in 1987 were even better. Pre-tax earnings rose 10% while average capital employed declined significantly. Ralph's mastery of the 19 businesses for which he is responsible is truly amazing, and he has also attracted some outstanding managers to run them. We would love to find a few additional units that could be put under Ralph's wing. The businesses of Scott Fetzer are too numerous to describe in detail. Let's just update you on one of our favorites. At the end of 1987, World Book introduced its most dramatically revised edition since 1962. The number of color photos was increased from 14,000 to 24,000. Over 6,000 articles were revised. 840 new contributors were added. Charlie and I recommend this product to you and your family, as we do World Book's products for younger children, Childcraft and Early World of Learning. In 1987, World Book unit sales in the United States increased for the fifth consecutive year. International sales and profits also grew substantially. The outlook is good for Scott Fetzer operations in aggregate, and for World Book in particular. Insurance operations shown below is an updated version of our usual table presenting key figures for the insurance industry. Yearly change in premiums written, %. Statutory combined ratio after policyholder dividends, yearly change in incurred losses, %. Inflation rate measured by GNP deflator, %. 1981 3.8 106.06.59.619824.4 109.88.46.41984.6 112.06.83.91984.9.2 117.9 16.93.8 1985.22.1 116.5 16.13.3 1986, Reverend. 22.2 108.0 13.52.61987, Est. 8.7 104.76.83.0 Source. Best's Insurance Management reports the combined ratio represents total insurance costs, losses incurred plus expenses, compared to revenue from premiums. A ratio below 100 indicates an underwriting profit, and one above 100 indicates a loss. When the investment income that an insurer earns from holding on to policyholders' funds, the float, is taken into account, a combined ratio in the 107 to 111 range typically produces an overall break-even result, exclusive of earnings on the funds provided by shareholders. The math of the insurance business, encapsulated by the table, is not very complicated. In years when the industry's annual gain in revenues, premiums, pokes along at 4% or 5%, underwriting losses are sure to mount. That is not because auto accidents, fires, windstorms and the like are occurring more frequently, nor has it lately been the fault of general inflation. Today, social and judicial inflation are the major culprits. The cost of entering a courtroom has simply ballooned. Part of the jump in cost arises from skyrocketing verdicts, and part from the tendency of judges and juries to expand the coverage of insurance policies beyond that contemplated by the insurer when the policies were written. Seeing no let-up in either trend, we continue to believe that the industry's revenues must grow at about 10% annually for it to just hold its own in terms of profitability, even though general inflation may be running at a considerably lower rate. The strong revenue gains of 1985 to 87 almost guaranteed the industry an excellent underwriting performance in 1987 and, indeed, it was a banner year. But the news soured as the quarters rolled by. Best's estimates that year-over-year volume increases were 12.9%, 11.1%, 5.7%, and 5.6%. In 1988, the revenue gain is certain to be far below our 10% equilibrium figure. Clearly, the party is over. However, earnings will not immediately sink. A lag factor exists in this industry. Because most policies are written for a one-year term, higher or lower insurance prices do not have their full impact on earnings until many months after they go into effect. Thus, to resume our metaphor, When the party ends and the bar is closed, you are allowed to finish your drink. If results are not hurt by a major natural catastrophe, we predict a small climb for the industry's combined ratio in 1988, followed by several years of larger increases. The insurance industry is cursed with a set of dismal economic characteristics that make for a poor long-term outlook, hundreds of competitors, ease of entry, and a product that cannot be differentiated in any meaningful way. In such a commodity-like business, only a very low-cost operator or someone operating in a protected, and usually small, niche can sustain high profitability levels. When shortages exist, however, even commodity businesses flourish. The insurance industry enjoyed that kind of climate for a while, but it is now gone. One of the ironies of capitalism is that most managers in commodity industries abhor shortage conditions, even though those are the only circumstances permitting them good returns. Whenever shortages appear, the typical manager simply can't wait to expand capacity and thereby plug the hole through which money is showering upon him. This is precisely what insurance managers did in 1985 to 87, confirming again Disraeli's observation: what we learn from history is that we do not learn from history. At Berkshire, we work to escape the industry's commodity economics in two ways. First, we differentiate our product by our financial strength, which exceeds that of all others in the industry. This strength, however, is limited in its usefulness. It means nothing in the personal insurance field. The buyer of an auto or homeowner's policy is going to get his claim paid even if his insurer fails, as many have.
It often means nothing in the commercial insurance arena. When times are good, many major corporate purchasers of insurance and their brokers pay scant attention to the insurer's ability to perform under the more adverse conditions that may exist, say, 5 years later when a complicated claim is finally resolved. Out of sight, out of mind, and, later on, maybe out of pocket. Periodically, however, buyers remember Ben Franklin's observation that it is hard for an empty sack to stand upright and recognize their need to buy promises only from insurers that have enduring financial strength.
It is then that we have a major competitive advantage. When a buyer really focuses on whether a $10 million claim can be easily paid by his insurer 5 or 10 years down the road, and when he takes into account the possibility that poor underwriting conditions may then coincide with depressed financial markets and defaults by reinsurer, he will find only a few companies he can trust. Among those, Berkshire will lead the pack. Our second method of differentiating ourselves is the total indifference to volume that we maintain. In 1989, we will be perfectly willing to write 5 times as much business as we write in 1988 or only 1/5 as much.
We hope, of course, that conditions will allow us large volume.
But we cannot control market prices. If they are unsatisfactory, we will simply do very little business. No other major insurer acts with equal restraint. 3 conditions that prevail in insurance, but not in most businesses, allow us our flexibility. First, market share is not an important determinant of profitability. In this business, in contrast to the newspaper or grocery businesses, the economic rule is not survival of the fattest. Second, in many sectors of insurance, including most of those in which we operate, distribution channels are not proprietary and can be easily entered. Small volume this year does not preclude huge volume next year. Third, idle capacity, which in this industry largely means people, does not result in intolerable costs.
In a way that industries such as printing or steel cannot, we can operate at quarter speed much of the time and still enjoy long-term prosperity. We follow a price based on exposure, not on competition policy, because it makes sense for our shareholders.
But we're happy to report that it is also pro-social. This policy means that we are always available, given prices that we believe are adequate, to write huge volumes of almost any type of property casualty insurance. Many other insurers follow an in and out approach.
When they are out, because of mounting losses, capital inadequacy, or whatever, we are available.
Of course, when others are panting to do business, we are also available, but at such times we often find ourselves priced above the market. In effect, we supply insurance buyers and brokers with a large reservoir of standby capacity. One story from mid-1987 illustrates some consequences of our pricing policy. One of the largest family-owned insurance brokers in the country is headed by a fellow who has long been a shareholder of Berkshire. This man handles a number of large risks that are candidates for placement with our New York office. Naturally, he does the best he can for his clients. And, just as naturally, when the insurance market softened dramatically in 1987, he found prices at other insurers lower than we were willing to offer. His reaction was, first, to place all of his business elsewhere and, second, to buy more stock in Berkshire. Had we been really competitive, he said, we would have gotten his insurance business, but he would not have bought our stock. Berkshire's underwriting experience was excellent in 1987, in part because of the lag factor discussed earlier. Our combined ratio, on a statutory basis and excluding structured settlements and financial reinsurance, was 105. Although the ratio was somewhat less favorable than in 1986, when it was 103, our profitability improved materially in 1987 because we had the use of far more float. This trend will continue to run in our favor. Our ratio of float to premium volume will increase very significantly during the next few years.
Thus, Berkshire's insurance profits are quite likely to improve during 1988 and 1989, even though we expect our combined ratio to rise.
Our insurance business has also made some important non-financial gains during the last few years. Mike Goldberg, its manager, has assembled a group of talented professionals to write larger risks and unusual coverages. His operation is now well equipped to handle the lines of business that will occasionally offer us major opportunities. Our loss reserve development, detailed on pages 41 to 42, looks better this year than it has previously.
But we write lots of long-tail business. That is, policies generating claims that often take many years to resolve.
Examples would be product liability, or directors' and officers' liability coverages.
With a business mix like this, 1 year of reserve development tells you very little.
You should be very suspicious of any earnings figures reported by insurers, including our own, as we have unfortunately proved to you in the past. The record of the last decade shows that a great many of our best-known insurers have reported earnings to shareholders that later proved to be wildly erroneous. In most cases, these errors were totally innocent. The unpredictability of our legal system makes it impossible for even the most conscientious insurer to come close to judging the eventual cost of long-tail claims.
Nevertheless, auditors annually certify the numbers given them by management and in their opinions unqualifiedly state that these figures present fairly the financial position of their clients.
The auditors use this reassuring language even though they know from long and painful experience that the numbers certified are likely to differ dramatically from the true earnings of the period. Despite this history of error, investors understandably rely upon auditors' opinions. After all, a declaration saying that the statements present fairly hardly sounds equivocal to the non-accountant. The wording in the auditor's standard opinion letter is scheduled to change next year. The new language represents improvement, but falls far short of describing the limitations of a casualty insurer audit. If it is to depict the true state of affairs, we believe the standard opinion letter to shareholders of a property casualty company should read something like, "We have relied upon representations of management in respect to the liabilities shown for losses and loss adjustment expenses, the estimate of which, in turn, very materially affects the earnings and financial condition herein reported. We can express no opinion about the accuracy of these figures. Subject to that important reservation, in our opinion, etc. If lawsuits develop in respect to wildly inaccurate financial statements, which they do, auditors will definitely say something of that sort in court anyway. Why should they not be forthright about their role and its limitations from the outset? We want to emphasize that we are not faulting auditors for their inability to accurately assess loss reserves, and therefore earnings. We fault them only for failing to publicly acknowledge that they can't do this job.
From all appearances, the innocent mistakes that are constantly made in reserving are accompanied by others that are deliberate.
Various charlatans have enriched themselves at the expense of the investing public by exploiting, first, the inability of auditors to evaluate reserve figures, and, second, the auditor's willingness to confidently certify those figures as if they had the expertise to do so. We will continue to see such chicanery in the future. Where earnings can be created by the stroke of a pen, the dishonest will gather. For them, long-tail insurance is heaven.
The audit wording we suggest would at least serve to put investors on guard against these predators.
The taxes that insurance companies pay, which increased materially, though on a delayed basis, upon enactment of the Tax Reform Act of 1986, took a further turn for the worse at the end of 1987. We detailed the 1986 changes in last year's report. We also commented on the irony of a statute that substantially increased 1987 reported earnings for insurers even as it materially reduced both their long-term earnings potential and their business value. At Berkshire, the temporarily helpful, fresh start adjustment inflated 1987 earnings by $8.2 million. In our opinion, the 1986 Act was the most important economic event affecting the insurance industry over the past decade. The 1987 bill further reduced the intercorporate dividends received credit from 80% to 70%, effective January 1, 1988, except for cases in which the taxpayer owns at least 20% of an investee. Investors who have owned stocks or bonds through corporate intermediaries other than qualified investment companies have always been disadvantaged in comparison to those owning the same securities directly. The penalty applying to indirect ownership was greatly increased by the 1986 tax bill and, to a lesser extent, by the 1987 bill, particularly in instances where the intermediary is an insurance company. We have no way of offsetting this increased level of taxation. It simply means that a given set of pre-tax investment returns will now translate into much poorer after-tax results for our shareholders. All in all, we expect to do well in the insurance business, though our record is sure to be uneven. The immediate outlook is for substantially lower volume but reasonable earnings improvement. The decline in premium volume will accelerate after our quota share agreement with Fireman's Fund expires in 1989. At some point, likely to be at least a few years away, we may see some major opportunities, for which we are now much better prepared than we were in 1985. Marketable securities, permanent holdings. Whenever Charlie and I buy common stocks for Berkshire's insurance companies, leaving aside arbitrage purchases, discussed later, we approach the transaction as if we were buying into a private business. We look at the economic prospects of the business, the people in charge of running it, and the price we must pay. We do not have in mind any time or price for sale. Indeed, we are willing to hold a stock indefinitely so long as we expect the business to increase in intrinsic value at a satisfactory rate. When investing, we view ourselves as business analysts, not as market analysts, not as macroeconomic analysts, and not even as security analysts. Our approach makes an active trading market useful, since it periodically presents us with mouth-watering opportunities.
But by no means is it essential. A prolonged suspension of trading in the securities we hold would not bother us any more than does the lack of daily quotations on World Book or Feckheimer.
Eventually, our economic fate will be determined by the economic fate of the business we own, whether our ownership is partial or total.
Ben Graham, my friend and teacher, long ago described the mental attitude toward market fluctuations that I believe to be most conducive to investment success.
He said that you should imagine market quotations as coming from a remarkably accommodating fellow named Mr. Market who is your partner in a private business. Without fail, Mr. Market appears daily and names a price at which he will either buy your interest or sell you his.
Even though the business that the two of you own may have economic characteristics that are stable, Mr. Market's quotations will be anything but.
For, sad to say, the poor fellow has incurable emotional problems. At times he feels euphoric and can see only the favorable factors affecting the business. When in that mood, he names a very high buy-sell price because he fears that you will snap up his interest and rob him of imminent gains.
At other times he is depressed and can see nothing but trouble ahead for both the business and the world.
On these occasions he will name a very low price, since he is terrified that you will unload your interest on him. Mr. Market has another endearing characteristic. He doesn't mind being ignored. If his quotation is uninteresting to you today, he will be back with a new one tomorrow. Transactions are strictly at your option. Under these conditions, the more manic-depressive his behavior, the better for you. But, like Cinderella at the ball, you must heed one warning or everything will turn into pumpkins and mice. Mr. Market is there to serve you, not to guide you. It is his pocketbook, not his wisdom, that you will find useful. If he shows up some day in a particularly foolish mood, you are free to either ignore him or to take advantage of him, but it will be disastrous if you fall under his influence. Indeed, if you aren't certain that you understand and can value your business far better than Mr. Market, you don't belong in the game. As they say in poker, if you've been in the game 30 minutes and you don't know who the patsy is, you're the patsy. Ben's Mr. Market allegory may seem out of date in today's investment world, in which most professionals and academicians talk of efficient markets, dynamic hedging and betas. Their interest in such matters is understandable, since techniques shrouded in mystery clearly have value to the purveyor of investment advice. After all, what witch doctor has ever achieved fame and fortune by simply advising, take 2 aspirins? The value of market esoterica to the consumer of investment advice is a different story. In my opinion, investment success will not be produced by arcane formulae, computer programs or signals flashed by the price behavior of stocks and markets. Rather, an investor will succeed by coupling good business judgment with an ability to insulate his thoughts and behavior from the super-contagious emotions that swirl about the marketplace. In my own efforts to stay insulated, I have found it highly useful to keep Ben's Mr. Market concept firmly in mind. Following Ben's teachings, Charlie and I let our marketable equities tell us by their operating results, not by their daily, or even yearly, price quotations, whether our investments are successful. The market may ignore business success for a while, but eventually will confirm it. As Ben said, in the short run, the market is a voting machine, but in the long run it is a weighing machine. The speed at which a business's success is recognized, furthermore, is not that important as long as the company's intrinsic value is increasing at a satisfactory rate. In fact, delayed recognition can be an advantage. It may give us the chance to buy more of a good thing at a bargain price. Sometimes, of course, the market may judge a business to be more valuable than the underlying facts would indicate it is. In such a case, we will sell our holdings. Sometimes, also, we will sell a security that is fairly valued or even undervalued because we require funds for a still more undervalued investment or one we believe we understand better. We need to emphasize, however, that we do not sell holdings just because they have appreciated or because we have held them for a long time. Of Wall Street maxims, the most foolish may be, you can't go broke taking a profit. We are quite content to hold any security indefinitely, so long as the prospective return on equity capital of the underlying business is satisfactory, management is competent and honest, and the market does not overvalue the business. However, our insurance companies own 3 marketable common stocks that we would not sell even though they became far overpriced in the market. In effect, we view these investments exactly like our successful controlled businesses, a permanent part of Berkshire rather than merchandise to be disposed of once Mr. Market offers us a sufficiently high price.
To that, I will add one qualifier. These stocks are held by our insurance companies and we would, if absolutely necessary, sell portions of our holdings to pay extraordinary insurance losses.
We intend, however, to manage our affairs so that sales are never required.
A determination to have and to hold, which Charlie and I share, obviously involves a mixture of personal and financial considerations. To some, our stand may seem highly eccentric. Charlie and I have long followed David Ogilvy's advice. Develop your eccentricities while you are young.
That way, when you get old, people won't think you're going gaga. Certainly, in the transaction-fixated Wall Street of recent years, our posture must seem odd. To many in that arena, both companies and stocks are seen only as raw material for trades. Our attitude, however, fits our personalities and the way we want to live our lives. Churchill once said, "You shape your houses and then they shape you." We know the manner in which we wish to be shaped. For that reason, we would rather achieve a return of X while associating with people whom we strongly like and admire than realize 110% of X by exchanging these relationships for uninteresting or unpleasant ones.
And we will never find people we like and admire more than some of the main participants at the three companies. Our permanent holdings, shown below. Shares Company Cost Market, O omitted, 3 million Capital Cities, ABC, Inc.
$517,500, $1,035,000, $6,850,000 Geico Corporation. $45,713, $756,925, $1,727,765 The Washington Post Company. $9,731, $323,092 We really don't see many fundamental differences between the purchase of a controlled business and the purchase of marketable holdings such as these. In each case we try to buy into businesses with favorable long-term economics. Our goal is to find an outstanding business at a sensible price, not a mediocre business at a bargain price. Charlie and I have found that making silk purses out of silk is the best that we can do. With sow's ears, we fail. It must be noted that your chairman, always a quick study, required only 20 years to recognize how important it was to buy good businesses. In the interim, I searched for bargains and had the misfortune to find some.
My punishment was an education in the economics of short-line farm implement manufacturers, third-place department stores, and New England textile manufacturers. Of course, Charlie and I may misread the fundamental economics of a business.
When that happens, we will encounter problems whether that business is a wholly owned subsidiary or a marketable security, although it is usually far easier to exit from the latter. Indeed, businesses can be misread. Witness the European reporter who, after being sent to this country to profile Andrew Carnegie, cabled his editor, "My God, you'll never believe the sort of money there is in running libraries." In making both control purchases and stock purchases, we try to buy not only good businesses, but ones run by high-grade, talented and likable managers. If we make a mistake about the managers we link up with, the controlled company offers a certain advantage because we have the power to effect change. In practice, however, this advantage is somewhat illusory. Management changes, like marital changes, are painful, time-consuming and chancy. In any event, at our three marketable but permanent holdings, this point is moot. With Tom Murphy and Dan Burke at Cap Cities, Bill Snyder and Lou Simpson at Geico, and Kay Graham and Dick Simmons at the Washington Post, we simply couldn't be in better hands. I would say that the controlled company offers two main advantages. First, when we control a company we get to allocate capital, whereas we are likely to have little or nothing to say about this process with marketable holdings. This point can be important because the heads of many companies are not skilled in capital allocation. Their inadequacy is not surprising. Most bosses rise to the top because they have excelled in an area such as marketing, production, engineering, administration or, sometimes, institutional politics. Once they become CEOs, they face new responsibilities. They now must make capital allocation decisions, a critical job that they may have never tackled and that is not easily mastered. To stretch the point, it's as if the final step for a highly talented musician was not to perform at Carnegie Hall but, instead, to be named chairman of the Federal Reserve. The lack of skill that many CEOs have at capital allocation is no small matter. After 10 years on the job, a CEO whose company annually retains earnings equal to 10% of net worth will have been responsible for the deployment of more than 60% of all the capital at work in the business. CEOs who recognize their lack of capital allocation skills, which not all do, will often try to compensate by turning to their staffs, management consultants, or investment bankers. Charlie and I have frequently observed the consequences of such help. On balance, we feel it is more likely to accentuate the capital allocation problem than to solve it. In the end, plenty of unintelligent capital allocation takes place in corporate America. That's why you hear so much about restructuring. Berkshire, however, has been fortunate. At the companies that are our major non-controlled holdings, capital has generally been well deployed and, in some cases, brilliantly so. The second advantage of a controlled company over a marketable security has to do with taxes. Berkshire, as a corporate holder, absorbs some significant tax costs through the ownership of partial positions that we do not when our ownership is 80% or greater. Such tax disadvantages have long been with us, but changes in the tax code caused them to increase significantly during the past year. As a consequence, a given business result can now deliver Berkshire financial results that are as much as 50% better if they come from an 80% or greater holding rather than from a lesser holding.
The disadvantages of owning marketable securities are sometimes offset by a huge advantage. Occasionally the stock market offers us the chance to buy non-controlling pieces of extraordinary businesses at truly ridiculous prices, dramatically below those commanded in negotiated transactions that transfer control.
For example, we purchased our Washington Post stock in 1973 at $5.63 per share, and per share operating earnings in 1987 after taxes were $10.30. Similarly, our Geico stock was purchased in 1976, 1979 and 1980 at an average of $6.67 per share, and after-tax operating earnings per share last year were $9.01. In cases such as these, Mr. Market has proven to be a mighty good friend. An interesting accounting irony overlays a comparison of the reported financial results of our controlled companies with those of the permanent minority holdings listed above. As you can see, those three stocks have a market value of over $2 billion. Yet they produced only $11 million in reported after-tax earnings for Berkshire in 1987. Accounting rules dictate that we take into income only the dividends these companies pay us, which are little more than nominal, rather than our share of their earnings, which in 1987 amounted to well over $100 million. On the other hand, accounting rules provide that the carrying value of these three holdings, owned, as they are, by insurance companies, must be recorded on our balance sheet at current market prices.
The result: GAAP accounting lets us reflect in our net worth the up-to-date underlying values of the businesses we partially own, but does not let us reflect their underlying earnings in our income account.
In the case of our controlled companies, just the opposite is true. Here, we show full earnings in our income account but never change asset values on our balance sheet, no matter how much the value of a business might have increased since we purchased it. Our mental approach to this accounting schizophrenia is to ignore GAAP figures and to focus solely on the future earning power of both our controlled and non-controlled businesses.
Using this approach, we establish our own ideas of business value, keeping these independent from both the accounting values shown on our books for controlled companies and the values placed by a sometimes foolish market on our partially owned companies. It is this business value that we hope to increase at a reasonable, or, preferably, unreasonable, rate in the years ahead. Marketable securities. In addition to our three permanent common stock holdings, we hold large quantities of marketable securities in our insurance companies. In selecting these, we can choose among 5 major categories. 1. Long-term common stock investments. 2. Medium-term fixed income securities. 3. Long-term fixed income securities. 4. Short-term cash equivalents. And 5. Short-term arbitrage commitments. We have no particular bias when it comes to choosing from these categories. We just continuously search among them for the highest after-tax returns as measured by mathematical expectation, limiting ourselves always to investment alternatives we think we understand. Our criteria have nothing to do with maximizing immediately reportable earnings. Our goal, rather, is to maximize eventual net worth. Let's look first at common stocks. During 1987, the stock market was an area of much excitement but little net movement. The Dow advanced 2.3% for the year. You were aware, of course, of the roller coaster ride that produced this minor change. Mr. Market was on a manic rampage until October and then experienced a sudden, massive seizure. We have professional investors, those who manage many billions, to thank for most of this turmoil.
Instead of focusing on what businesses will do in the years ahead, many prestigious money managers now focus on what they expect other money managers to do in the days ahead. For them, stocks are merely tokens in a game, like the thimble and flatiron in Monopoly. An extreme example of what their attitude leads to is portfolio insurance, a money management strategy that many leading investment advisors embraced in 1986-1987. This strategy, which is simply an exotically labeled version of the small speculator's stop-loss order, dictates that ever-increasing portions of a stock portfolio, or their index future equivalents, be sold as prices decline. The strategy says nothing else matters. A downtick of a given magnitude automatically produces a huge sell order. According to the Brady Report, $60 billion to $90 billion of equities were poised on this hair trigger in mid-October of 1987. If you thought that investment advisors were hired to invest, you may be bewildered by this technique. After buying a farm, would a rational owner next order his real estate agent to start selling off pieces of it whenever a neighboring property was sold at a lower price? Or would you sell your house to whatever bidder was available at 9:31 on some morning merely because at 9:30 a similar house sold for less than it would have brought on the previous day? Moves like that, however, are what portfolio insurance tells a pension fund or university to make when it owns a portion of enterprises such as Ford or General Electric. The less these companies are being valued at, says this approach, the more vigorously they should be sold. As a logical corollary, the approach commands the institutions to repurchase these companies. I'm not making this up, once their prices have rebounded significantly. Considering that huge sums are controlled by managers following such Alice in Wonderland practices, is it any surprise that markets sometimes behave in aberrational fashion? Many commentators, however, have drawn an incorrect conclusion upon observing recent events. They are fond of saying that the small investor has no chance in a market now dominated by the erratic behavior of the big boys. This conclusion is dead wrong. Such markets are ideal for any investor, small or large, so long as he sticks to his investment knitting. Volatility caused by money managers who speculate irrationally with huge sums will offer the true investor more chances to make intelligent investment moves. He can be hurt by such volatility only if he is forced, by either financial or psychological pressures, to sell at untoward times. At Berkshire, we have found little to do in stocks during the past few years. During the break in October, a few stocks fell to prices that interested us, but we were unable to make meaningful purchases before they rebounded. At year-end 1987, we had no major common stock investments, that is, over $50 million, other than those we consider permanent or arbitrage holdings. However, Mr. Market will offer us opportunities, you can be sure of that, and, when he does, we will be willing and able to participate. In the meantime, our major parking place for money is medium-term tax-exempt bonds, whose limited virtues I explained in last year's annual report. Though we both bought and sold some of these bonds in 1987, our position changed little overall, holding around $900 million. A large portion of our bonds are grandfathered under the Tax Reform Act of 1986, which means they are fully tax-exempt. Bonds currently purchased by insurance companies are not. As an alternative to short-term cash equivalents, our medium-term tax-exempts have, so far, served us well. They have produced substantial extra income for us and are currently worth a bit above our cost. Regardless of their market price, we are ready to dispose of our bonds whenever something better comes along. We continue to have an aversion to long-term bonds, and may be making a serious mistake by not disliking medium-term bonds as well. Bonds are no better than the currency in which they are denominated, and nothing we have seen in the past year, or past decade, makes us enthusiastic about the long-term future of U.S. currency. Our enormous trade deficit is causing various forms of claim checks, U.S. government and corporate bonds, bank deposits, etc., to pile up in the hands of foreigners at a distressing rate. By default, our government has adopted an approach to its finances patterned on that of Blanche Dubois, of A Streetcar Named Desire, who said, "I have always depended on the kindness of strangers. In this case, of course, the strangers are relying on the integrity of our claim checks, although the plunging dollar has already made that proposition expensive for them. The faith that foreigners are placing in us may be misfounded. When the claim checks outstanding grow sufficiently numerous and when the issuing party can unilaterally determine their purchasing power, the pressure on the issuer to dilute their value by inflating the currency becomes almost irresistible. For the debtor government, the weapon of inflation is the economic equivalent of the H-bomb, and that is why very few countries have been allowed to swamp the world with debt denominated in their own currency. Our past, relatively good record for fiscal integrity has let us break this rule, but the generosity accorded us is likely to intensify, rather than relieve, the eventual pressure on us to inflate. If we do succumb to that pressure, it won't be just the foreign holders of our claim checks who will suffer. It will be all of us as well. Of course, the U.S. may take steps to stem our trade deficit well before our position as a net debtor gets out of hand.
In that respect, the falling dollar will help, though unfortunately it will hurt in other ways. Nevertheless, our government's behavior in this test of its mettle is apt to be consistent with its Scarlett O'Hara approach generally. I'll think about it tomorrow. And, almost inevitably, procrastination in facing up to fiscal problems will have inflationary consequences.
Both the timing and the sweep of those consequences are unpredictable. But our inability to quantify or time the risk does not mean we should ignore it. While recognizing the possibility that we may be wrong and that present interest rates may adequately compensate for the inflationary risk, we retain a general fear of long-term bonds. We are, however, willing to invest a moderate portion of our funds in this category if we think we have a significant edge in a specific security. That willingness explains our holdings of the Washington Public Power Supply System's number 1, number 2 and number 3 issues, discussed in our 1984 report.
We added to our WPPSS position during 1987.
At year-end, we had holdings with an amortized cost of $240 million and a market value of $316 million, paying us tax-exempt income of $34 million annually. We continued to do well in arbitrage last year, though, or perhaps because we operated on a very limited scale. We enter into only a few arbitrage commitments each year and restrict ourselves to large transactions that have been publicly announced. We do not participate in situations in which green mailers are attempting to put a target company in play. We have practiced arbitrage on an opportunistic basis for decades and, to date, our results have been quite good. Though we've never made an exact calculation, I believe that overall we have averaged annual pre-tax returns of at least 25% from arbitrage. I'm quite sure we did better than that in 1987.
But it should be emphasized that a really bad experience or two, such as many arbitrage operations suffered in late 1987, could change the figures dramatically. Our only $50 million plus arbitrage position at year-end 1987 was 1,096,200 shares of Allegis, with a cost of $76 million and a market value of $78 million.
We had two other large holdings at year-end that do not fit precisely into any of our 5 categories. One was various Texaco, Inc. bonds with short maturities, all purchased after Texaco went into bankruptcy.
Were it not for the extraordinarily strong capital position of our insurance companies, it would be inappropriate for us to buy defaulted bonds. At prices prevailing after Texaco's bankruptcy filing, however, we regarded these issues as by far the most attractive bond investment available to us.
On a worst-case basis with respect to the Pennzoil litigation, we felt the bonds were likely to be worth about what we paid for them. Given a sensible settlement, which seemed likely, we expected the bonds to be worth considerably more. At year-end, our Texaco bonds were carried on our books at $104 million and had a market value of $119 million. By far our largest, and most publicized, investment in 1987 was a $700 million purchase of Solomon Inc. 9% preferred stock. This preferred is convertible after 3 years into Solomon common stock at $38 per share and, if not converted, will be redeemed ratably over 5 years beginning October 31, 1995. From most standpoints, this commitment fits into the medium-term fixed income securities category. In addition, we have an interesting conversion possibility.
We, of course, have no special insights regarding the direction or future profitability of investment banking.
By their nature, the economics of this industry are far less predictable than those of most other industries in which we have major commitments. This unpredictability is one of the reasons why our participation is in the form of a convertible preferred. What we do have a strong feeling about is the ability and integrity of John Gutfriend, CEO of Solomon Inc. Charlie and I admire and trust John. We first got to know him in 1976 when he played a key role in Geico's escape from near bankruptcy.
Several times since, we have seen John steer clients away from transactions that would have been unwise, but that the client clearly wanted to make, even though his advice provided no fee to Solomon and acquiescence would have delivered a large fee.
Such service above self behavior is far from automatic in Wall Street. For the reasons Charlie outlines on page 50, at year-end we valued our Solomon investment at 98% of par, $14 million less than our cost. However, we believe there is a reasonable likelihood that a leading, high-quality capital raising and market-making operation can average good returns on equity. If so, our conversion right will eventually prove to be valuable. 2 further comments about our investments in marketable securities are appropriate. First, we give you our usual warning. Our holdings have changed since year-end and will continue to do so without notice. The second comment is related. During 1987, as in some earlier years, there was speculation in the press from time to time about our purchase or sale of various securities. These stories were sometimes true, sometimes partially true, and other times completely untrue.
Interestingly, there has been no correlation between the size and prestige of the publication and the accuracy of the report. One dead-wrong rumor was given considerable prominence by a major national magazine, and another leading publication misled its readers by writing about an arbitrage position as if it were a long-term investment commitment. In not naming names, I am observing the old warning that it's not wise to pick fights with people who buy ink by the barrel. You should understand that we simply don't comment in any way on rumors, whether they are true or false. If we were to deny the incorrect reports and refuse comment on the correct ones, we would in effect be commenting on all.
In a world in which big investment ideas are both limited and valuable, we have no interest in telling potential competitors what we are doing except to the extent required by law. We certainly don't expect others to tell us of their investment ideas. Nor would we expect a media company to disclose news of acquisitions it was privately pursuing or a journalist to tell his competitors about stories on which he is working or sources he is using. I find it uncomfortable when friends or acquaintances mention that they are buying X because it has been reported, incorrectly, that Berkshire is a buyer. However, I do not set them straight. If they want to participate in whatever Berkshire actually is buying, they can always purchase Berkshire stock. But perhaps that is too simple.
Usually, I suspect, they find it more exciting to buy what is being talked about.
Whether that strategy is more profitable is another question. Financing shortly after year-end, Berkshire sold 2 issues of debentures, totaling $250 million. Both issues mature in 2018 and will be retired at an even pace through sinking fund operations that begin in 1999. Our overall interest cost, after allowing for expenses of issuance, is slightly over 10%. Solomon was our investment banker, and its service was excellent. Despite our pessimistic views about inflation, our taste for debt is quite limited. To be sure, it is likely that Berkshire could improve its return on equity by moving to a much higher, though still conventional, debt-to-business value ratio. It's even more likely that we could handle such a ratio, without problems, under economic conditions far worse than any that have prevailed since the early 1930s. But we do not wish it to be only likely that we can meet our obligations, we wish that to be certain. Thus we adhere to policies, both in regard to debt and all other matters, that will allow us to achieve acceptable long-term results under extraordinarily adverse conditions, rather than optimal results under a normal range of conditions. Good business or investment decisions will eventually produce quite satisfactory economic results, with no aid from leverage. Therefore, it seems to us to be both foolish and improper to risk what is important, including, necessarily, the welfare of innocent bystanders such as policyholders and employees, for some extra returns that are relatively unimportant. This view is not the product of either our advancing age or prosperity. Our opinions about debt have remained constant. However, we are not phobic about borrowing. We're far from believing that there is no fate worse than debt. We are willing to borrow an amount that we believe, on a worst-case basis, will pose no threat to Berkshire's well-being. Analyzing what that amount might be, we can look to some important strengths that would serve us well if major problems should engulf our economy. Berkshire's earnings come from many diverse and well-entrenched businesses. These businesses seldom require much capital investment. What debt we have is structured well, and we maintain major holdings of liquid assets. Clearly, we could be comfortable with a higher debt-to-business value ratio than we now have. One further aspect of our debt policy deserves comment. Unlike many in the business world, we prefer to finance in anticipation of need rather than in reaction to it. A business obtains the best financial results possible by managing both sides of its balance sheet well. This means obtaining the highest possible return on assets and the lowest possible cost on liabilities. It would be convenient if opportunities for intelligent action on both fronts coincided. However, reason tells us that just the opposite is likely to be the case. Tight money conditions, which translate into high costs for liabilities, will create the best opportunities for acquisitions, and cheap money will cause assets to be bid to the sky. Our conclusion: action on the liability side should sometimes be taken independent of any action on the asset side. Alas, what is tight and cheap money is far from clear at any particular time. We have no ability to forecast interest rates and, maintaining our usual open-minded spirit, believe that no one else can. Therefore, we simply borrow when conditions seem non-oppressive and hope that we will later find intelligent expansion or acquisition opportunities, which, as we have said, are most likely to pop up when conditions in the debt market are clearly oppressive. Our basic principle is that if you want to shoot rare, fast-moving elephants, you should always carry a loaded gun. Our fund first, buy or expand later policy almost always penalizes near-term earnings. For example, we are now earning about 6.5% on the $250 million we recently raised at 10%, a disparity that is currently costing us about $160,000 per week. This negative spread is unimportant to us and will not cause us to stretch for either acquisitions or higher-yielding short-term instruments. If we find the right sort of business elephant within the next 5 years or so, the wait will have been worthwhile. Miscellaneous: we hope to buy more businesses that are similar to the ones we have, and we can use some help. If you have a business that fits the following criteria, call me or, preferably, write.
Here's what we're looking for. 1. Large purchases. At least $10 million of after-tax earnings. 2. Demonstrated consistent earning power. Future projections are of little interest to us, nor are turnaround situations. 3. Businesses earning good returns on equity while employing little or no debt. 4. Management in place. We can't supply it. 5. Simple businesses. If there's lots of technology, we won't understand it. 6. An offering price. We don't want to waste our time or that of the seller by talking, even preliminarily, about a transaction when price is unknown.
We will not engage in unfriendly takeovers. We can promise complete confidentiality and a very fast answer, customarily within 5 minutes, as to whether we're interested. We prefer to buy for cash, but will consider issuing stock when we receive as much in intrinsic business value as we give. We invite potential sellers to check us out by contacting people with whom we have done business in the past. For the right business, and the right people, we can provide a good home. On the other hand, we frequently get approached about acquisitions that don't come close to meeting our tests, new ventures, turnarounds, auction-like sales, and the ever-popular, among brokers, I'm sure something will work out if you people get to know each other. None of these attracts us in the least. Besides being interested in the purchases of entire businesses as described above, we are also interested in the negotiated purchase of large, but not controlling, blocks of stock comparable to those we hold in Cap Cities and Solomon. We have a special interest in purchasing convertible preferreds as a long-term investment, as we did at Solomon. And now a bit of déjà vu. Most of Berkshire's major stockholders received their shares at year-end 1969 in a liquidating distribution from Buffett Partnership, Limited. Some of these former partners will remember that in 1962 I encountered severe managerial problems at Dempster Mill Manufacturing Company, a pump and farm implement manufacturing company that BPL controlled. At that time, like now, I went to Charlie with problems that were too tough for me to solve. Charlie suggested the solution might lie in a California friend of his, Harry Bottle, whose special knack was never forgetting the fundamental. I met Harry in Los Angeles on April 17, 1962, and on April 23 he was in Beatrice, Nebraska, running Dempster. Our problems disappeared almost immediately. In my 1962 annual letter to partners, I named Harry Man of the Year. Fade to 24 years later. The scene is K&W Products, a small Berkshire subsidiary that produces automotive compounds. For years K&W did well, but in 1985-86 it stumbled badly, as it pursued the unattainable to the neglect of the achievable. Charlie, who oversees K&W, knew there was no need to consult me.
Instead, he called Harry, now 68 years old, made him CEO, and sat back to await the inevitable.
He didn't wait long.
In 1987 K&W's profits set a record, up more than 300% from 1986.
And, as profits went up, capital employed went down. K&W's investment in accounts receivable and inventories has decreased 20%. If we run into another managerial problem 10 or 20 years down the road, you know whose phone will ring.
About 97.2% of all eligible shares participated in Berkshire's 1987 Shareholder Designated Contributions Program.
Contributions made through the program were $4.9 million, and 2,050 charities were recipients. A recent survey reported that about 50% of major American companies matched charitable contributions made by directors, sometimes by a factor of 3 to 1. In effect, these representatives of the owners direct funds to their favorite charities, and never consult the owners as to their charitable preferences. I wonder how they would feel if the process were reversed and shareholders could invade the directors' pockets for charities favored by the shareholders. When A takes money from B to give to C and A is a legislator, the process is called taxation. But when A is an officer or director of a corporation, it is called philanthropy. We continue to believe that contributions, aside from those with quite clear direct benefits to the company, should reflect the charitable preferences of owners rather than those of officers and directors. We urge new shareholders to read the description of our Shareholder Designated Contributions Program that appears on pages 54 and 55. If you wish to participate in future programs, we strongly urge that you immediately make sure your shares are registered in the name of the actual owner, not in street name or nominee name. Shares not so registered on September 30, L988 will be ineligible for the 1988 program. Last year we again had about 450 shareholders at our annual meeting. The 60 or so questions they asked were, as always, excellent.
At many companies, the annual meeting is a waste of time because exhibitionists turn it into a sideshow.
Ours, however, is different. It is informative for shareholders and fun for us. At Berkshire's meetings, the exhibitionists are on the dais. This year our meeting will be on May 23, 1988 in Omaha, and we hope that you come. The meeting provides the forum for you to ask any owner-related questions you may have, and we will keep answering until all, except those dealing with portfolio activities or other proprietary information, have been dealt with. Last year we rented 2 buses, for $100 to take shareholders interested in the trip to the furniture mart. Your actions demonstrated your good judgment. You snapped up about $40,000 of bargains. Mrs. B regards this expense-sales ratio as on the high side and attributes it to my chronic inattention to costs and generally sloppy managerial practices. But, gracious as always, she has offered me another chance and we will again have buses available following the meeting. Mrs. B says you must beat last year's sales figures, and I have told her she won't be disappointed. Warren E. Buffett, Chairman of the Board. (1988) Letter Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Inc. Our gain in net worth during 1988 was $569 million, or 20.0%. Over the last 24 years, that is, since present management took over, our per-share book value has grown from $19.46 to $2,974.52, or at a rate of 23.0% compounded annually. We've emphasized in past reports that what counts, however, is intrinsic business value, the figure, necessarily an estimate, indicating what all of our constituent businesses are worth. By our calculations, Berkshire's intrinsic business value significantly exceeds its book value. Over the 24 years, business value has grown somewhat faster than book value. In 1988, however, book value grew the faster, by a bit. Berkshire's past rates of gain in both book value and business value were achieved under circumstances far different from those that now exist. Anyone ignoring these differences makes the same mistake that a baseball manager would were he to judge the future prospects of a 42-year-old center fielder on the basis of his lifetime batting average. Important negatives affecting our prospects today are: 1. A less attractive stock market than generally existed over the past 24 years. 2. Higher corporate tax rates on most forms of investment income. 3. A far more richly priced market for the acquisition of businesses. And 4. Industry conditions for Capital Cities, ABC, Inc., Geico Corporation, and the Washington Post Company, Berkshire's 3 permanent investments, constituting about one-half of our net worth, that ranged from slightly to materially less favorable than those existing 5 to 10 years ago. All of these companies have superb management and strong properties. But, at current prices, their upside potential looks considerably less exciting to us today than it did some years ago. The major problem we face, however, is a growing capital base. You've heard that from us before, but this problem, like age, grows in significance each year. And also, just as with age, it's better to have this problem continue to grow rather than to have it solved. 4 years ago I told you that we needed profits of $3.9 billion to achieve a 15% annual return over the decade then ahead. Today, for the next decade, a 15% return demands profits of $10.3 billion. That seems like a very big number to me and to Charlie Munger, Berkshire's vice chairman and my partner. Should that number indeed prove too big, Charlie will find himself, in future reports, retrospectively identified as the senior partner. As a partial offset to the drag that our growing capital base exerts upon returns, we have a very important advantage now that we lacked 24 years ago. Then, all our capital was tied up in a textile business with inescapably poor economic characteristics. Today part of our capital is invested in some really exceptional businesses. Last year we dubbed these operations the Sainted Seven: Buffalo News, Feckheimer, Kirby, Nebraska Furniture Mart, Scott Fetzer Manufacturing Group, Seas, and World Book. In 1988, the Saints came marching in. You can see just how extraordinary their returns on capital were by examining the historical cost financial statements on page 45, which combine the figures of the Sainted Seven with those of several smaller units. With no benefit from financial leverage, this group earned about 67% on average equity capital. In most cases, the remarkable performance of these units arises partially from an exceptional business franchise. In all cases, an exceptional management is a vital factor. The contribution Charlie and I make is to leave these managers alone. In my judgment, these businesses, in aggregate, will continue to produce superb returns. We'll need these. Without this help, Berkshire would not have a chance of achieving our 15% goal. You can be sure that our operating managers will deliver. The question mark in our future is whether Charlie and I can effectively employ the funds that they generate. In that respect, we took a step in the right direction early in 1989 when we purchased an 80% interest in Borsheim's, a jewelry business in Omaha. This purchase, described later in this letter, delivers exactly what we look for: an outstanding business run by people we like, admire, and trust. It's a great way to start the year. Accounting changes: we have made a significant accounting change that was mandated for 1988, and likely will have another to make in 1990. When we move figures around from year to year, without any change in economic reality, one of our always thrilling discussions of accounting is necessary. First, I'll offer my customary disclaimer. Despite the shortcomings of generally accepted accounting principles, GAAP, I would hate to have the job of devising a better set of rules. The limitations of the existing set, however, need not be inhibiting. CEOs are free to treat GAAP statements as a beginning rather than an end to their obligation to inform owners and creditors, and indeed they should. After all, any manager of a subsidiary company would find himself in hot water if he reported bare-bones GAAP numbers that omitted key information needed by his boss, the parent corporation's CEO. Why, then, should the CEO himself withhold information vitally useful to his bosses, the shareholder owners of the corporation? What needs to be reported as data? Whether GAAP, non-GAAP, or extra GAAP, that helps financially literate readers answer three key questions. 1. Approximately how much is this company worth? 2. What is the likelihood that it can meet its future obligations? And 3. How good a job are its managers doing, given the hand they have been dealt? In most cases, answers to one or more of these questions are somewhere between difficult and impossible to glean from the minimum GAAP presentation. The business world is simply too complex for a single set of rules to effectively describe economic reality for all enterprises, particularly those operating in a wide variety of businesses, such as Berkshire. Further complicating the problem is the fact that many managements view GAAP not as a standard to be met, but as an obstacle to overcome. Too often their accountants willingly assist them. How much, says the client, is 2 plus 2? Replies the cooperative accountant. What number did you have in mind? Even honest and well-intentioned managements sometimes stretch GAAP a bit in order to present figures they think will more appropriately describe their performance. Both the smoothing of earnings and the big bath, quarter or white lie techniques employed by otherwise upright managements. Then there are managers who actively use GAAP to deceive and defraud. They know that many investors and creditors accept GAAP results as gospel. So these charlatans interpret the rules imaginatively and record business transactions in ways that technically comply with GAAP but actually display an economic illusion to the world. As long as investors, including supposedly sophisticated institutions, place fancy valuations on reported earnings that march steadily upward, you can be sure that some managers and promoters will exploit GAAP to produce such numbers, no matter what the truth may be. Over the years, Charlie and I have observed many accounting-based frauds of staggering size. Few of the perpetrators have been punished, many have not even been censured. It has been far safer to steal large sums with a pen than small sums with a gun. Under one major change mandated by GAAP for 1988, we have been required to fully consolidate all our subsidiaries in our balance sheet and earnings statement. In the past, Mutual Savings and Loan, and Scott Fetzer Financial, a credit company that primarily finances installment sales of World Book and Kirby products, were consolidated on a one-line basis. That meant we, 1. Showed our equity in their combined net worths as a single entry asset on Berkshire's consolidated balance sheet and, 2. Included our equity in their combined annual earnings as a single-line income entry in our consolidated statement of earnings. Now the rules require that we consolidate each asset and liability of these companies in our balance sheet and each item of their income and expense in our earnings statement. This change underscores the need for companies also to report segmented data. The greater the number of economically diverse business operations lumped together in conventional financial statements, the less useful those presentations are and the less able investors are to answer the three questions posed earlier. Indeed, the only reason we ever prepare consolidated figures at Berkshire is to meet outside requirements. On the other hand, Charlie and I constantly study our segment data. Now that we are required to bundle more numbers in our GAAP statements, we have decided to publish additional supplementary information that we think will help you measure both business value and managerial performance. Berkshire's ability to discharge its obligations to creditors, the third question we listed, should be obvious, whatever statements you examine. In these supplementary presentations, we will not necessarily follow GAAP procedures, or even corporate structure. Rather, we will attempt to lump major business activities in ways that aid analysis but do not swamp you with detail. Our goal is to give you important information in a form that we would wish to get it if our roles were reversed. On pages 41 to 47 we show separate combined balance sheets and earnings statements for 1. Our subsidiaries engaged in finance-type operations, which are Mutual Savings and Scott Fetzer Financial. 2. Our insurance operations, with their major investment positions itemized. 3. Our manufacturing, publishing and retailing businesses, leaving aside certain non-operating assets and purchase price accounting adjustments. And 4. An all other category that includes the non-operating assets, primarily marketable securities, held by the companies in 3. As well as various assets and debts of the Wesco and Berkshire parent companies. If you combine the earnings and the net worths of these four segments, you will derive totals matching those shown on our GAAP statements. However, we want to emphasize that our new presentation does not fall within the purview of our auditors, who in no way bless it. In fact, they may be horrified. I don't want to ask. I referred earlier to a major change in GAAP that is expected in 1990. This change relates to the calculation of deferred taxes, and is both complicated and controversial, so much so that its imposition, originally scheduled for 1989, was postponed for a year. When implemented, the new rule will affect us in various ways. Most important, we will be required to change the way we calculate our liability for deferred taxes on the unrealized appreciation of stocks held by our insurance companies. Right now, our liability is layered. For the unrealized appreciation that dates back to 1986 and earlier years, $1.2 billion, we have booked a 28% tax liability. For the unrealized appreciation built up since, $600 million, the tax liability has been booked at 34%. The difference reflects the increase in tax rates that went into effect in 1987. It now appears, however, that the new accounting rule will require us to establish the entire liability at 34% in 1990, taking the charge against our earnings. Assuming no change in tax rates by 1990, this step will reduce our earnings in that year, and thereby our reported net worth, by $71 million. The proposed rule will also affect other items on our balance sheet, but these changes will have only a minor impact on earnings and net worth. We have no strong views about the desirability of this change in calculation of deferred taxes. We should point out, however, that neither a 28% nor a 34% tax liability precisely depicts economic reality at Berkshire, since we have no plans to sell the stocks in which we have the great bulk of our gains. To those of you who are uninterested in accounting, I apologize for this dissertation. I realize that many of you do not pore over our figures, but instead hold Berkshire primarily because you know that 1. Charlie and I have the bulk of our money in Berkshire. 2. We intend to run things so that your gains or losses are in direct proportion to ours. And 3. The record has so far been satisfactory. There is nothing necessarily wrong with this kind of faith approach to investing. Other shareholders, however, prefer an analysis approach, and we want to supply the information they need. In our own investing, we search for situations in which both approaches give us the same answer. Sources of reported earnings. In addition to supplying you with our new 4-sector accounting material, we will continue to list the major sources of Berkshire's reported earnings just as we have in the past. In the following table, amortization of goodwill and other major purchase price accounting adjustments are not charged against the specific businesses to which they apply but are instead aggregated and shown separately. This procedure lets you view the earnings of our businesses as they would have been reported had we not purchased them. I've explained in past reports why this form of presentation seems to us to be more useful to investors and managers than the standard GAAP presentation, which makes purchase price adjustments on a business-by-business basis. The total net earnings we show in the table are, of course, identical to the GAAP total in our audited financial statements. Further information about these businesses is given in the business segment section on pages 32 to 34, and in the management's discussion section on pages 36 to 40. In these sections you also will find our segment earnings reported on a GAAP basis. For information on Wesco's businesses, I urge you to read Charlie Munger's letter, which starts on page 52. It contains the best description I have seen of the events that produced the present savings and loan crisis. Also, take special note of Dave Hillstrom's performance at Precision Steel Warehouse, a Wesco subsidiary. Precision operates in an extremely competitive industry, yet Dave consistently achieves good returns on invested capital. Though data is lacking to prove the point, I think it is likely that his performance, both in 1988 and years past, would rank him number 1 among his peers. Operating earnings. Omitted. Pre-tax 1988 earnings 1987 Berkshire 1988 share 1987 Insurance Group. Underwriting $11,081, $55,429, $1,045, $20,696, net investment income $231,250 $152, $483,197, $779 $136,658 Buffalo News 42,429 39,410 25,462 21,304 Feckheimer. Acquired 3 June 86. 14,152 13,332 7,700 26,580 Kirby 26,891 22,408 17,842 12,891 Nebraska Furniture Mart 18,439 16,837 9,099 7,554 Scott Fetzer, Diversified MFG 28,542 30,591 17,640 17,555 See's Candies 32,473 31,693 19,671 17,363 Wesco. Other than insurance 16,133 6,209 10,654 978 World Book 27,890 25,745 18,021 15,135 Amortization of goodwill 2,806 2,862 2,806 2,862 Other purchase price accounting charges 6,342, 5,546, 7,340, 6,544. Interest on debt and prepayment penalty, 35,613, 11,474, 23,212, 5,905, Shareholder designated contributions, 4,966, 4,938, 3,217, 2,963, other 41,059, 23,217, 27,177, 13,696, operating earnings 418,450, 280, 919,313, 441, 214,745, sales of securities 131,671, 28,838, 85,829, 19,807, total earnings all entities $550,121, $310,514, $399,270, $234,552, excludes interest expense of Scott Fetzer Financial Group. The earnings achieved by our operating businesses are superb, whether measured on an absolute basis or against those of their competitors. For that we thank our operating managers. You and I are fortunate to be associated with them. At Berkshire, associations like these last a long time. We do not remove superstars from our lineup merely because they have attained a specified age, whether the traditional 65 or the 95 reached by Mrs. B on the eve of Hanukkah in 1988. Superb managers are too scarce a resource to be discarded simply because a cake gets crowded with candles. Moreover, our experience with newly minted MBAs has not been that great. Their academic records always look terrific and the candidates always know just what to say, but too often they are short on personal commitment to the company and general business savvy. It's difficult to teach a new dog old tricks. Here's an update on our major non-insurance operations. At Nebraska Furniture Mart, Mrs. B. Rose Blumkin, and her cart roll on and on. She's been the boss for 51 years, having started the business at 44 with $500. Think what she would have done with $1,000, with Mrs. B. Old age will always be 10 years away. The Mart, along the largest home furnishings store in the country, continues to grow. In the fall, the store opened a detached 20,000 square foot clearance center, which expands our ability to offer bargains in all price ranges. Recently, Dillard's, one of the most successful department store operations in the country, entered the Omaha market. In many of its stores, Dillard's runs a full furniture department, undoubtedly doing well in this line. Shortly before opening in Omaha, however, William Dillard, chairman of the company, announced that his new store would not sell furniture. Said he, referring to NFM, "We don't want to compete with them. We think they are about the best there is." At the Buffalo News we extol the value of advertising, and our policies at NFM prove that we practice what we preach. Over the past 3 years NFM has been the largest ROP advertiser in the Omaha World Herald. ROP advertising is the kind printed in the paper, as contrasted to the pre-printed insert kind. In no other major market, to my knowledge, is a home furnishings operation the leading customer of the newspaper. At times, we also run large ads in papers as far away as Des Moines, Sioux City and Kansas City, always with good results. It truly does pay to advertise, as long as you have something worthwhile to offer. Mrs. B's son, Louis, and his boys, Ron and Irv, complete the winning Blumkin team. It's a joy to work with this family. All its members have character that matches their extraordinary abilities. Last year I stated unequivocally that pre-tax margins at the Buffalo News would fall in 1988. That forecast would have proved correct at almost any other newspaper our size or larger. But Stan Lipsey, bless him, has managed to make me look foolish. Though we increased our prices a bit less than the industry average last year, and though our newsprint costs and wage rates rose in line with industry norms, Stan actually improved margins a tad. No one in the newspaper business has a better managerial record. He has achieved it, furthermore, while running a paper that gives readers an extraordinary amount of news. We believe that our newshole percentage, the portion of the paper devoted to news, is bigger than that of any other dominant paper of our size or larger. The percentage was 49.5% in 1988 versus 49.8% in 1987. We are committed to keeping it around 50%, whatever the level or trend of profit margins. Charlie and I have loved the newspaper business since we were youngsters, and we have had great fun with the news in the 12 years since we purchased it. We were fortunate to find Murray Light, a top-flight editor, on the scene when we arrived, and he has made us proud of the paper ever since. O.C.'s Candies sold a record £25.1 million in 1988. Prospects did not look good at the end of October, but excellent Christmas volume, considerably better than the record set in 1987, turned the tide. As we've told you before, C's business continues to become more Christmas concentrated. In 1988, the company earned a record 90% of its full-year profits in December, $29 million out of $32.5 million before tax. It's enough to make you believe in Santa Claus. December's deluge of business produces a modest seasonal bulge in Berkshire's corporate earnings. Another small bulge occurs in the first quarter, when most World Book annuals are sold. Charlie and I put Chuck Huggins in charge of C's about 5 minutes after we bought the company. Upon reviewing his record, you may wonder what took us so long. At Feckheimer, the Heldmans, Bob, George, Gary, Roger and Fred, are the Cincinnati counterparts of the Blumkins. Neither furniture retailing nor uniform manufacturing has inherently attractive economics. In these businesses, only exceptional managements can deliver high returns on invested capital. And that's exactly what the five Heldmans do. As Mets announcer Ralph Kiner once said when comparing pitcher Steve Trout to his father, Dizzy Trout, the famous Detroit Tigers pitcher, there's a lot of heredity in that family. Feckheimer made a fairly good-sized acquisition in 1988. Charlie and I have such confidence in the business savvy of the Heldman family that we okayed the deal without even looking at it. There are very few managements anywhere, including those running the top-tier companies of the Fortune 500, in which we would exhibit similar confidence. Because of both this acquisition and some internal growth, sales at Feckheimer should be up significantly in 1989. All of the operations managed by Ralph Shea, World Book, Kirby, and the Scott Fetzer Manufacturing Group, performed splendidly in 1988. Returns on the capital entrusted to Ralph continue to be exceptional. Within the Scott Fetzer Manufacturing Group, particularly fine progress was recorded at its largest unit, Campbell Hausfeld. This company, the country's leading producer of small and medium-sized air compressors, has more than doubled earnings since 1986. Unit sales at both Kirby and World Book were up significantly in 1988, with export business particularly strong. World Book became available in the Soviet Union in September, when that country's largest American bookstore opened in Moscow. Ours is the only general encyclopedia offered at the store. Ralph's personal productivity is amazing. In addition to running 19 businesses in superb fashion, he is active at the Cleveland Clinic, Ohio University, Case Western Reserve, and a venture capital operation that has spawned 16 Ohio-based companies and resurrected many others. Both Ohio and Berkshire are fortunate to have Ralph on their side. Borsheim's It was in 1983 that Berkshire purchased an 80% interest in the Nebraska Furniture Mart. Your chairman blundered then by neglecting to ask Mrs. B a question any schoolboy would have thought of. Are there any more at home like you? Last month I corrected the error. We are now 80% partners with another branch of the family. After Mrs. B came over from Russia in 1917, her parents and 5 siblings followed. Her 2 other siblings had preceded her. Among the sisters was Rebecca Friedman, who, with her husband, Louis, escaped in 1922 to the west through Latvia in a journey as perilous as Mrs. B's earlier odyssey to the east through Manchuria. When the family members reunited in Omaha, they had no tangible assets.
However, they came equipped with an extraordinary combination of brains, integrity, and enthusiasm for work, and that's all they needed.
They have since proved themselves invincible. In 1948, Mr. Friedman purchased Borsheim's, a small Omaha jewelry store.
He was joined in the business by his son, Ike, in 1950, and, as the years went by, Ike's son, Alan, and his sons-in-law, Marvin Cohn and Donald Yale, came in also. You won't be surprised to learn that this family brings to the jewelry business precisely the same approach that the Blumkins bring to the furniture business.
The cornerstone for both enterprises is Mrs. B's creed. Sell cheap and tell the truth. Other fundamentals at both businesses are 1. Single-store operations featuring huge inventories that provide customers with an enormous selection across all price ranges. 2. Daily attention to detail by top management. 3. Rapid turnover. 4. Shrewd buying. And 5. Incredibly low expenses. The combination of the last three factors lets both stores offer everyday prices that no one in the country comes close to matching. Most people, no matter how sophisticated they are in other matters, feel like babes in the woods when purchasing jewelry. They can judge neither quality nor price. For them only one rule makes sense: if you don't know jewelry, know the jeweler. I can assure you that those who put their trust in Ike Friedman and his family will never be disappointed. The way in which we purchased our interest in their business is the ultimate testimonial. Borsheim's had no audited financial statements. Nevertheless, we didn't take inventory, verify receivables, or audit the operation in any way.
Ike simply told us what was so, and on that basis we drew up a one-page contract and wrote a large check.
Business at Borsheim's has mushroomed in recent years as the reputation of the Friedman family has spread. Customers now come to the store from all over the country.
Among them have been some friends of mine from both coasts who thanked me later for getting them there.
Borsheim's new links to Berkshire will change nothing in the way this business is run. All members of the Friedman family will continue to operate just as they have before. Charlie and I will stay on the sidelines where we belong. And when we say, all members, the words have real meaning. Mr. and Mrs. Friedman, at 88 and 87, respectively, are in the store daily. The wives of Ike, Alan, Marvin and Donald all pitch in at busy times, and a fourth generation is beginning to learn the ropes. It is great fun to be in business with people you have long admired. The Friedmans, like the Blumkins, have achieved success because they have deserved success. Both families focus on what's right for the customer, and that, inevitably, works out well for them, also. We couldn't have better partners.
Insurance operations shown below is an updated version of our usual table presenting key figures for the insurance industry. Yearly change in premiums written, %. Statutory combined ratio after policyholder dividends, yearly change in incurred losses, %. Inflation rate measured by GNP deflator, %. 1981 3.8 106.06.59.6 1982 4.4 109.88.46.4 1983 4.61 12.06.83.9 1984 9.2 117.9 16.93.8 1985 22.1 116.5 16.13.3 1986 22.2 108.0 13.5 2.7 1987 9.4 104.67.8 3.3 1988 Est 3.9 105.44.23.6 Source AM Best Co. The combined ratio represents total insurance costs, losses incurred plus expenses, compared to revenue from premiums. A ratio below 100 indicates an underwriting profit, and one above 100 indicates a loss.
When the investment income that an insurer earns from holding on to policyholders' funds, the float, is taken into account, a combined ratio in the 107 to 111 range typically produces an overall break-even result, exclusive of earnings on the funds provided by shareholders. For the reasons laid out in previous reports, we expect the industry's incurred losses to grow by about 10% annually, even in years when general inflation runs considerably lower. If premium growth meanwhile materially lags that 10% rate, underwriting losses will mount, though the industry's tendency to underreserve when business turns bad may obscure their size for a time. As the table shows, the industry's underwriting loss grew in 1988. This trend is almost certain to continue, and probably will accelerate, for at least 2 more years. The property casualty insurance industry is not only subnormally profitable, it is subnormally popular. As Sam Goldwyn philosophized, in life, one must learn to take the bitter with the sour. One of the ironies of business is that many relatively unprofitable industries that are plagued by inadequate prices habitually find themselves beat upon by irate customers, even while other, hugely profitable industries are spared complaints, no matter how high their prices.
Take the breakfast cereal industry, whose return on invested capital is more than double that of the auto insurance industry, which is why companies like Kellogg and General Mills sell at 5 times book value and most large insurers sell close to book.
The cereal companies regularly impose price increases, few of them related to a significant jump in their costs. Yet not a peep is heard from consumers. But when auto insurers raise prices by amounts that do not even match cost increases, customers are outraged. If you want to be loved, it's clearly better to sell high-priced cornflakes than low-priced auto insurance.
The antagonism that the public feels toward the industry can have serious consequences. Proposition 103, a California initiative passed last fall, threatens to push auto insurance prices down sharply, even though costs have been soaring.
The price cut has been suspended while the courts review the initiative, but the resentment that brought on the vote has not been suspended. Even if the initiative is overturned, insurers are likely to find it tough to operate profitably in California.
Thank heavens the citizenry isn't mad at bonbons. If Proposition 103 applied to candy as well as insurance, See's would be forced to sell its product for $5.76 per pound.
Rather than the $7.60 we charge, and would be losing money by the bucketful. The immediate direct effects on Berkshire from the initiative are minor, since we saw few opportunities for profit in the rate structure that existed in California prior to the vote. However, the forcing down of prices would seriously affect Geico, our 44% owned investee, which gets about 10% of its premium volume from California. Even more threatening to Geico is the possibility that similar pricing actions will be taken in other states, through either initiatives or legislation. If voters insist that auto insurance be priced below cost, it eventually must be sold by government. Stockholders can subsidize policyholders for a short period, but only taxpayers can subsidize them over the long term. At most property casualty companies, socialized auto insurance would be no disaster for shareholders. Because of the commodity characteristics of the industry, most insurers earn mediocre returns and therefore have little or no economic goodwill to lose if they are forced by government to leave the auto insurance business. But Geico, because it is a low-cost producer able to earn high returns on equity, has a huge amount of economic goodwill at risk. In turn, so do we. At Berkshire, in 1988, our premium volume continued to fall, and in 1989 we will experience a large decrease for a special reason. The contract through which we receive 7% of the business of Fireman's Fund expires on August 31st. At that time, we will return to Fireman's Fund the unearned premiums we hold that relate to the contract.
This transfer of funds will show up in our premiums written account as a negative $85 million or so and will make our third quarter figures look rather peculiar. However, the termination of this contract will not have a significant effect on profits.
Berkshire's underwriting results continued to be excellent in 1988. Our combined ratio, on a statutory basis and excluding structured settlements and financial reinsurance, was 104. Reserve development was favorable for the second year in a row, after a string of years in which it was very unsatisfactory.
Details on both underwriting and reserve development appear on pages 36 to 38.
Our insurance volume over the next few years is likely to run very low, since business with a reasonable potential for profit will almost certainly be scarce. So be it. At Berkshire, we simply will not write policies at rates that carry the expectation of economic loss.
We encounter enough troubles when we expect a gain.
Despite, or perhaps because of, low volume, our profit picture during the next few years is apt to be considerably brighter than the industry's. We are sure to have an exceptional amount of float compared to premium volume, and that augurs well for profits. In 1989 and 1990 we expect our float premiums ratio to be at least 3 times that of the typical property casualty company. Mike Goldberg, with special help from Ajit Jain, Dinos Iordano, and the National Indemnity managerial team, has positioned us well in that respect. At some point, we don't know when, we will be deluged with insurance business. The cause will probably be some major physical or financial catastrophe. But we could also experience an explosion in business, as we did in 1985, because large and increasing underwriting losses at other companies coincide with their recognition that they are far underreserved. In the meantime, we will retain our talented professionals, protect our capital, and try not to make major mistakes. Marketable securities. In selecting marketable securities for our insurance companies, we can choose among 5 major categories. 1. Long-term common stock investments. 2. Medium-term fixed income securities. 3. Long-term fixed income securities. 4. Short-term cash equivalents. And 5. Short-term arbitrage commitments. We have no particular bias when it comes to choosing from these categories. We just continuously search among them for the highest after-tax returns as measured by mathematical expectation, limiting ourselves always to investment alternatives we think we understand. Our criteria have nothing to do with maximizing immediately reportable earnings. Our goal, rather, is to maximize eventual net worth. Below we list our common stock holdings having a value over $100 million, not including arbitrage commitments, which will be discussed later. A small portion of these investments belongs to subsidiaries of which Berkshire owns less than 100%. Shares Company Cost Market, omitted, 3 million Capital Cities, ABC, Inc.
$517,500, $1,086,750, $14,172,500. The Coca-Cola Company, $592,500, $4,632,448, $2,400,000. Federal Home Loan Mortgage Corporation, Preferred *$71,729, $121,206, $1,850,000. Geico Corporation, $45,713, $849,400, $1,727,765. The Washington Post Company, $9,731, $364,126. Although nominally a preferred stock, this security is financially equivalent to a common stock.
Our permanent holdings, Capital Cities, ABC, Inc., Geico Corporation, and the Washington Post Company, remain unchanged.
Also unchanged is our unqualified admiration of their managements. Tom Murphy and Dan Burke at Cap Cities, Bill Snyder and Lou Simpson at Geico, and Kay Graham and Dick Simmons at the Washington Post.
Charlie and I appreciate enormously the talent and integrity these managers bring to their businesses.
Their performance, which we have observed at close range, contrasts vividly with that of many CEOs, which we have fortunately observed from a safe distance.
Sometimes these CEOs clearly do not belong in their jobs. Their positions, nevertheless, are usually secure. The supreme irony of business management is that it is far easier for an inadequate CEO to keep his job than it is for an inadequate subordinate.
If a secretary, say, is hired for a job that requires typing ability of at least 80 words a minute and turns out to be capable of only 50 words a minute, she will lose her job in no time.
There is a logical standard for this job. Performance is easily measured, and if you can't make the grade, you're out. Similarly, if new salespeople fail to generate sufficient business quickly enough, they will be let go. Excuses will not be accepted as a substitute for orders. However, a CEO who doesn't perform is frequently carried indefinitely. One reason is that performance standards for his job seldom exist.
When they do, they are often fuzzy or they may be waived or explained away, even when the performance shortfalls are major and repeated. At too many companies, the boss shoots the arrow of managerial performance and then hastily paints the bullseye around the spot where it lands.
Another important, but seldom recognized, distinction between the boss and the foot soldier is that the CEO has no immediate superior whose performance is itself getting measured. The sales manager who retains a bunch of lemons in his sales force will soon be in hot water himself. It is in his immediate self-interest to promptly weed out his hiring mistakes. Otherwise, he himself may be weeded out. An office manager who has hired inept secretaries faces the same imperative. But the CEO's boss is a board of directors that seldom measures itself and is infrequently held to account for substandard corporate performance. If the board makes a mistake in hiring, and perpetuates that mistake, so what? Even if the company is taken over because of the mistake, the deal will probably bestow substantial benefits on the outgoing board members.
The bigger they are, the softer they fall. Finally, relations between the board and the CEO are expected to be congenial.
At board meetings, criticism of the CEO's performance is often viewed as the social equivalent of belching. No such inhibitions restrain the office manager from critically evaluating the substandard typist. These points should not be interpreted as a blanket condemnation of CEOs or boards of directors. Most are able and hardworking, and a number are truly outstanding. But the management failings that Charlie and I have seen make us thankful that we are linked with the managers of our 3 permanent holdings. They love their businesses, they think like owners, and they exude integrity and ability. In 1988 we made major purchases of Federal Home Loan Mortgage PFD, Freddie Mac, and Coca-Cola. We expect to hold these securities for a long time. In fact, when we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever. We are just the opposite of those who hurry to sell and book profits when companies perform well but who tenaciously hang on to businesses that disappoint. Peter Lynch aptly likens such behavior to cutting the flowers and watering the weeds.
Our holdings of Freddie Mac are the maximum allowed by law, and are extensively described by Charlie in his letter.
In our consolidated balance sheet, these shares are carried at cost rather than market, since they are owned by Mutual Savings and Loan, a non-insurance subsidiary. We continue to concentrate our investments in a very few companies that we try to understand well. There are only a handful of businesses about which we have strong long-term convictions. Therefore, when we find such a business, we want to participate in a meaningful way. We agree with Mae West. Too much a good thing can be wonderful. We reduced our holdings of medium-term tax-exempt bonds by about $100 million last year. All of the bonds sold were acquired after August 7, 1986. When such bonds are held by property casualty insurance companies, 15% of the tax-exempt interest earned is subject to tax. The $800 million position we still hold consists almost entirely of bonds, grandfathered, under the Tax Reform Act of 1986, which means they are entirely tax-exempt. Our sales produced a small profit and our remaining bonds, which have an average maturity of about 6 years, are worth modestly more than carrying value. Last year we described our holdings of short-term and intermediate-term bonds of Texaco, which was then in bankruptcy. During 1988, we sold practically all of these bonds at a pre-tax profit of about $22 million. This sale explains close to $100 million of the reduction in fixed income securities on our balance sheet. We also told you last year about our holdings of another security whose predominant characteristics are those of an intermediate fixed income issue, our $700 million position in Solomon Inc. 9% convertible preferred. This preferred has a sinking fund that will retire it in equal annual installments from 1995 to 1999. Berkshire carries this holding at cost. For reasons discussed by Charlie on page 69, the estimated market value of our holding has improved from moderately under cost at the end of last year to moderately over cost at 1988 year-end. The close association we have had with John Gutfriend, CEO of Solomon, during the past year has reinforced our admiration for him. But we continue to have no great insights about the near, intermediate or long-term economics of the investment banking business. This is not an industry in which it is easy to forecast future levels of profitability. We continue to believe that our conversion privilege could well have important value over the life of our preferred. However, the overwhelming portion of the preferred's value resides in its fixed income characteristics, not its equity characteristics. Oh, we have not lost our aversion to long-term bonds. We will become enthused about such securities only when we become enthused about prospects for long-term stability in the purchasing power of money. And that kind of stability isn't in the cards. Both society and elected officials simply have too many higher-ranking priorities that conflict with purchasing power stability. The only long-term bonds we hold are those of Washington Public Power Supply Systems, WPPSS. A few of our WPPSS bonds have short maturities, and many others, because of their high coupons, are likely to be refunded and paid off in a few years. Overall, our WPPSS holdings are carried on our balance sheet at $247 million and have a market value of about $352 million. We explained the reasons for our WPPSS purchases in the 1983 annual report, and are pleased to tell you that this commitment has worked out about as expected. At the time of purchase, most of our bonds were yielding around 17% after taxes and carried no ratings, which had been suspended. Recently, the bonds were rated A by Standard & Poor's. They now sell at levels only slightly below those enjoyed by top-grade credits. In the 1983 report, we compared the economics of our WPPSS purchase to those involved in buying a business. As it turned out, this purchase actually worked out better than did the general run of business acquisitions made in 1983, assuming both are measured on the basis of unleveraged, after-tax returns achieved through 1988. Our WPPSS experience, though pleasant, does nothing to alter our negative opinion about long-term bonds. It only makes us hope that we run into some other large stigmatized issue, whose troubles have caused it to be significantly misappraised by the market. Arbitrage. In past reports, we have told you that our insurance subsidiaries sometimes engage in arbitrage as an alternative to holding short-term cash equivalents. We prefer, of course, to make major long-term commitments, but we often have more cash than good ideas. At such times, arbitrage sometimes promises much greater returns than treasury bills and, equally important, cools any temptation we may have to relax our standards for long-term investments. Charlie's sign-off after we've talked about an arbitrage commitment is usually, "Okay, at least it will keep you out of bars." During 1988 we made unusually large profits from arbitrage, measured both by absolute dollars and rate of return. Our pre-tax gain was about $78 million on average invested funds of about $147 million. This level of activity makes some detailed discussion of arbitrage and our approach to it appropriate.
Once, the word applied only to the simultaneous purchase and sale of securities or foreign exchange in two different markets.
The goal was to exploit tiny price differentials that might exist between, say, Royal Dutch stock trading in guilders in Amsterdam, pounds in London, and dollars in New York. Some people might call this scalping. It won't surprise you that practitioners opted for the French term, arbitrage.
Since World War I, the definition of arbitrage, or risk arbitrage, as it is now sometimes called, has expanded to include the pursuit of profits from an announced corporate event such as sale of the company, merger, recapitalization, reorganization, liquidation, self-tender, etc.
In most cases, the arbitrager expects to profit regardless of the behavior of the stock market. The major risk he usually faces instead is that the announced event won't happen. Some offbeat opportunities occasionally arise in the arbitrage field. I participated in one of these when I was 24 and working in New York for Graham Newman Corp. Rockwood & Company, a Brooklyn-based chocolate products company of limited profitability, had adopted LIFO inventory valuation in 1941 when cocoa was selling for 50 cents per pound. In 1954, a temporary shortage of cocoa caused the price to soar to over 60 cents. Consequently, Rockwood wished to unload its valuable inventory quickly before the price dropped.
But if the cocoa had simply been sold off, the company would have owed close to a 50% tax on the proceeds.
The 1954 tax code came to the rescue. It contained an arcane provision that eliminated the tax otherwise due on LIFO profits if inventory was distributed to shareholders as part of a plan reducing the scope of a corporation's business. Rockwood decided to terminate one of its businesses, the sale of cocoa butter, and said 13 million pounds of its cocoa bean inventory was attributable to that activity. Accordingly, the company offered to repurchase its stock in exchange for the cocoa beans it no longer needed, paying 80 pounds of beans for each share. For several weeks I busily bought shares, sold beans, and made periodic stops at Schroeder Trust to exchange stock certificates for warehouse receipts. The profits were good and my only expense was subway tokens. The architect of Rockwood's restructuring was an unknown, but brilliant Chicagoan, J. Pritzker, then 32. If you're familiar with Jay's subsequent record, you won't be surprised to hear the action worked out rather well for Rockwood's continuing shareholders also. From shortly before the tender until shortly after it, Rockwood stock appreciated from 15 to 100, even though the company was experiencing large operating losses. Sometimes there is more to stock valuation than price-earnings ratios. In recent years, most arbitrage operations have involved takeovers, friendly and unfriendly. With acquisition fever rampant, with antitrust challenges almost non-existent, and with bids often ratcheting upward, arbitrageurs have prospered mightily. They have not needed special talents to do well. The trick, a la Peter Sellers in the movie, has simply been being there. In Wall Street, the old proverb has been reworded. Give a man a fish and you feed him for a day.
Teach him how to arbitrage and you feed him forever. If, however, he studied at the Ivan Boesky School of Arbitrage, it may be a state institution that supplies his meals. To evaluate arbitrage situations you must answer 4 questions. 1. How likely is it that the promised event will indeed occur?
2. How long will your money be tied up? 3. What chance is there that something still better will transpire, a competing takeover bid, for example? And 4. What will happen if the event does not take place because of antitrust action, financing glitches, etc.? Arcata Corp. One of our more serendipitous arbitrage experiences, illustrates the twists and turns of the business. On September 28, 1981, the directors of Arcata agreed in principle to sell the company to Kohlberg, Kravis, Roberts & Company. KKR, then and now a major leveraged buyout firm. Arcata was in the printing and forest products businesses and had one other thing going for it. In 1978, the U.S. government had taken title to 10,700 acres of Arcata timber, primarily old-growth redwood, to expand Redwood National Park. The government had paid $97.9 million, in several installments, for this acreage, a sum Arcata was contesting as grossly inadequate. The parties also disputed the interest rate that should apply to the period between the taking of the property and final payment for it. The enabling legislation stipulated 6% simple interest. Arcata argued for a much higher and compounded rate. Buying a company with a highly speculative, large-sized claim in litigation creates a negotiating problem, whether the claim is on behalf of or against the company. To solve this problem, KKR offered $37 per Arcata share plus 2/3 of any additional amounts paid by the government for the redwood lands. Appraising this arbitrage opportunity, we had to ask ourselves whether KKR would consummate the transaction since, among other things, its offer was contingent upon its obtaining satisfactory financing. A clause of this kind is always dangerous for the seller. It offers an easy exit for a suitor whose ardor fades between proposal and marriage. However, we were not particularly worried about this possibility because KKR's past record for closing had been good. We also had to ask ourselves what would happen if the KKR deal did fall through, and here we also felt reasonably comfortable. Arcata's management and directors had been shopping the company for some time and were clearly determined to sell. If KKR went away, Arcata would likely find another buyer, though of course, the price might be lower. Finally, we had to ask ourselves what the redwood claim might be worth. Your chairman, who can't tell an elm from an oak, had no trouble with that one. He coolly evaluated the claim at somewhere between zero and a whole lot. We started buying Arcata stock, then around $33.50, on September 30th, and in 8 weeks purchased about 400,000 shares, or 5% of the company. The initial announcement said that the $37 would be paid in January 1982. Therefore, if everything had gone perfectly, we would have achieved an annual rate of return of about 40%, not counting the redwood claim, which would have been frosting. All did not go perfectly. In December it was announced that the closing would be delayed a bit. Nevertheless, a definitive agreement was signed on January 4. Encouraged,